Most traders think a trade starts when they hit buy or sell. Wrong. The real trade begins long before that, while analyzing, planning, and mastering your mindset. One wrong thought, one unchecked emotion, and the market will destroy you before you even enter. Master the unseen moments, and profits follow relentlessly. Every trader who loses before they even enter the trade. That statement might feel harsh at first, but it's closer to the truth than most realize. The majority of traders spend their entire careers chasing the illusion that success lies in the charts, in the perfect indicators, or in some secret strategy that promises to turn every trade into profit. They believe that if they just find the right setup, the market will reward them. Yet, time and again, they are blindsided, not by the market, but by themselves. Trading isn't just about candles, price levels, or signals. Trading begins in your mind. Long before you place that order, before the chart forms its patterns, before any technical indicator flashes its signal, the real battle is already underway. It is a battle against doubt, impatience, greed, fear, and all the subtle psychological traps that lurk in the mind of every trader. Consider the trader who spends hours preparing a perfect setup. The entry aligns with trend, the risk-reward ratio is ideal, the indicators confirm the move. On paper, it's flawless. They click the buy button with confidence, and for a moment, it seems like everything is going according to plan. Then, a sudden impulse hits, an irrational fear that the market might reverse, or an overpowering urge to take profit too early. Within moments, they make a decision that contradicts their plan. Despite the technical perfection of their setup, the trade ends in a loss. The mistake wasn't the trade, it wasn't the market, it was the mind. Every winning trade requires alignment between strategy and psychology. Without that alignment, no method, no matter how advanced, can save you. The misconception that trading is a purely external skill is one of the most dangerous traps for beginners. You might think that studying patterns, mastering indicators, or following signals will make you profitable. These tools are important, but they are secondary. The foundation of consistent trading success is internal. It is built from self-discipline, emotional control, preparation, and clarity of thought. This foundation determines whether your plans are executed flawlessly or sabotaged by impulse. Traders often underestimate this because the mind is invisible. You cannot quantify it with charts, you cannot backtest it with indicators, and you cannot teach it in a conventional trading course. Yet it is the single factor that dictates the difference between repeated losses and consistent growth. Imagine a trader who wakes up early, studies charts meticulously, and identifies what seems to be a high-probability setup. They read articles, analyze historical data, and even backtest the pattern over the past year. Everything points toward a favorable trade, but as the execution moment arrives, a whisper of doubt creeps in. What if this is a trap? What if the market moves against me? What if I lose my hard-earned money? That doubt, often subconscious, clouds judgment. Decisions that once seemed clear now feel uncertain. Even the most experienced trader can fall into this mental trap. The trade is lost before it begins, not because the strategy failed, but because the mind failed to follow through. Emotions are the invisible enemy in trading. Fear and greed are not just cliches, they are powerful forces that hijack rational thinking. Fear can make a trader hesitant, causing them to miss opportunities or exit positions prematurely. Greed can inflate confidence, leading to over-leveraging or chasing setups that no longer fit the plan. Both arise naturally, but the difference between a profitable trader and a losing trader is not the presence of these emotions, it's the ability to manage them. Emotional control is not a trait that some are born with, it is a skill that can be developed, owned, and reinforced over time. Preparation is the weapon, discipline is the shield, and awareness is the strategy. These mental tools determine whether a trader can stick to their rules, execute with patience, and avoid impulsive decisions that derail results. Consider the anecdote of a trader who entered a trade based on a textbook pattern. They had followed their criteria to the letter: proper entry, defined stop loss, clear target. The setup was perfect, yet the trade ended in a loss. On review, it wasn't a market anomaly that caused the failure, it was a decision made halfway through the trade. A small, seemingly harmless thought, maybe I should adjust the stop loss. Maybe I should take some profit now. Maybe this trade isn't going to work, led to a deviation from the plan. That single moment of doubt changed the outcome. The lesson is not just to trust the system, it's to trust yourself and the process you've designed. Your mind must be as disciplined as your method. Without that alignment, even perfect setups crumble. Preparation is more than just analyzing charts, it is setting up the mind to act with clarity under pressure. This includes defining rules for entries, exits, and risk management. But it also involves mental rehearsal, visualization, and honest reflection on past mistakes. Top traders often spend as much time on preparation as they do on execution, because they know that a well-prepared mind is less likely to be hijacked by emotion. Discipline is built gradually. It comes from repeated adherence to rules, from learning to pause before acting on impulse, and from cultivating patience in a world that demands instant results. The process of internal preparation transforms the chaos of the market into a controlled environment where rational decisions can thrive. Think about your last 3 trades. Did you enter impulsively? Did you exit too early out of fear, or hold too long out of hope? Did your actions match your plan, or were they guided by fleeting emotions? Most traders, when they honestly reflect, realize that the losses they suffered were not caused by the market, but by their own mental state. Recognizing this is the first step toward mastery. Awareness of your internal triggers, the habits, biases, and emotional reactions that interfere with execution, allows you to develop strategies to mitigate them. This is where real trading begins, long before the chart provides any signal. Success in trading is not a result of complexity, it is a result of consistency. That consistency is built in the mind. Every rule you follow, every moment you resist an impulsive decision, every time you execute exactly as planned, reinforces your mental framework. Over time, this framework becomes second nature. You no longer react, you respond. You no longer chase, you wait. You no longer panic, you manage. The market remains unpredictable, but your mind becomes a stable foundation capable of navigating uncertainty. Emotional mastery and disciplined preparation give you the edge that no indicator, algorithm, or secret system can replicate. Before the chart, before the candle, before execution, the trade has already been decided in the mind. Your mental state determines whether the trade is approached with clarity or clouded by doubt. It determines whether your rules are obeyed or broken. It determines whether your account grows steadily or dwindles in frustration. This is the core idea. Trading starts with self-mastery. The visible actions, the clicks, the entries, the exits, are simply reflections of what has already been determined internally. Every moment of hesitation, every impulsive action, every deviation from the plan originates in the mind. Mastering this internal battlefield is not optional, it is essential. The good news is that these skills are learnable. Emotional control, disciplined preparation, and mindful execution are habits that can be developed, strengthened, and automated through consistent practice. Like any skill, they require attention, repetition, and honest feedback. The process begins with awareness, identifying where your mindset fails, and continues with deliberate effort to build resilience, patience, and clarity. As you strengthen your mental foundation, every setup you execute becomes more reliable, not because the market has changed, but because you have changed. The journey toward elite trading is a shift in perspective. It requires you to stop blaming the market or external circumstances and start taking full responsibility for your decisions. It requires you to recognize that every loss, every mistake, every moment of hesitation is an opportunity to refine your internal process. The strategies, indicators, and systems are merely tools. The real power lies in the mind, the ability to act rationally under pressure, to follow rules without compromise, and to remain disciplined in the face of uncertainty. When you embrace this truth, everything changes. You stop chasing the perfect setup and start perfecting yourself. You stop hoping the market will reward impulsive actions and start preparing to respond with clarity. You stop trading based on emotions and start trading based on disciplined execution. This mindset shift is the gateway to consistent performance, stable growth, and a trading career that is not defined by luck or chance, but by mastery over yourself. Preparation is the invisible stage where most trading victories are won. It is the work that happens long before any trade is placed, the silent effort that separates those who survive in the markets from those who falter. Many traders underestimate preparation because it doesn't involve immediate action or visible results. Charts don't move while you are planning, profits don't accumulate, and losses don't disappear. Yet this stage is the foundation upon which every successful trade rests. Without thorough preparation, even the most promising setups are vulnerable to failure, because the mind, left unconditioned, will always find ways to sabotage execution. Preparation begins with understanding what it truly means to be ready. Market research, chart analysis, and risk management are the standard tools of any trader, but mental readiness is equally important. It's not enough to know the price patterns or the indicators. You must also know your own tendencies, your emotional triggers, and your capacity for risk. Mental preparation bridges the gap between knowledge and execution. It allows you to act with clarity rather than react with emotion. Without it, even the most precise technical strategy can collapse under pressure. Pre-trade planning is the practical application of preparation. Every trade should be mapped out before a single click occurs. This includes defining the entry point, the exit point, the stop, loss level, and the position size. Each of these elements should be determined based on logic, not on impulse. By setting these parameters in advance, you remove the possibility of making decisions under the influence of sudden emotions. The market will always throw surprises, but a well-prepared trader has a framework in place to respond calmly. This framework is the difference between a disciplined trader and someone who reacts to every price fluctuation. A checklist approach is one of the most effective tools in pre-trade planning. Just as pilots run through a series of steps before takeoff, a trader benefits from systematically verifying that every condition is met. Is the setup valid according to your strategy? Does the risk-reward ratio meet your criteria? Is the position size aligned with your account limits? Have you considered the potential emotional impact of the trade? A checklist prevents impulsive decisions and ensures consistency. It reduces the chances of entering a trade out of boredom, frustration, or the need to do something. By externalizing the process, the checklist shifts the control from emotion to reason. Mindset conditioning is an often overlooked but critical component of preparation. Visualization is a powerful technique used by top traders and athletes alike. Before entering a trade, take a moment to imagine both the profitable outcome and the loss scenario. See yourself following the plan exactly, reacting calmly if the trade moves against you, and taking profit without hesitation. This mental rehearsal prepares you for the uncertainty inherent in the markets. When the real trade arrives, your mind has already experienced it, and fear or greed has less power to disrupt your decisions. Emotional rehearsal goes hand in hand with visualization. Traders must anticipate the psychological challenges they will face. Fear can make you hesitate or exit prematurely. Greed can inflate confidence and tempt you to overtrade. Uncertainty can cloud judgment and lead to hesitation. By mentally experiencing these emotions in advance, you develop the ability to recognize and manage them in real time. Preparation is not just about rules, it's about cultivating resilience under pressure. It's about training the mind to respond deliberately, rather than react impulsively to every market fluctuation. The tools and systems that support preparation are equally important. A trading journal allows you to track your decisions, reflect on mistakes, and reinforce positive habits. A trading plan defines your strategy, risk parameters, and goals, ensuring that each trade has a clear purpose. Pre-trade routines, such as reviewing charts, checking news, and confirming conditions, create a consistent environment for execution. These tools transform preparation from a vague intention into a structured, repeatable process. Traders who rely solely on intuition or spontaneous decision-making are more likely to be undone by emotion. Those who combine knowledge, planning, and mental conditioning gain a tangible edge. Real-life examples illustrate the power of preparation. Top traders rarely, if ever, enter a trade without a pre-defined plan. They treat each setup like a mission briefing. They know the entry, the exit, the stop-loss, and the position size before placing the order. They anticipate both success and failure. They understand that preparation is a proactive measure that prevents mistakes rather than a reactive measure that attempts to fix them afterward. The calm, disciplined behavior of these traders is not luck, it is the result of invisible work done before the charts are even examined. Preparation has another hidden benefit. It prevents emotional destruction before it begins. When you walk into a trade knowing exactly what to do and how to react to every possible scenario, fear and greed lose their power. The chaos of the market becomes manageable because your mind has a pre-defined map to follow. You are not reacting to every candle or price swing, you are executing a plan with confidence. This is why preparation is more than a procedural step, it is a safeguard for your capital, your psychology, and your long-term success. The mindset of a prepared trader contrasts sharply with that of an impulsive trader. Impulsive traders jump from chart to chart, reacting to news, price action, or gut feelings. They rarely set parameters in advance, and when the market moves against them, panic dictates their decisions. Prepared traders, on the other hand, act with intention. They follow the process, trust their plan, and treat every trade as a deliberate experiment rather than a gamble. The discipline built during preparation translates directly into execution, reducing mistakes and increasing consistency. Commenting on preparation often elicits a surprising response. Most traders admit they skip it entirely. They might perform some technical analysis, but mental rehearsal, emotional conditioning, and strict pre-trade routines are frequently ignored. This omission explains why so many trades fail despite appearing sound on paper. The missing element is not strategy, it is readiness. Preparation transforms potential failure into controlled execution. It equips the trader to face the unpredictable nature of the market without succumbing to internal pressures. Preparation also accelerates learning. By defining your parameters and recording your actions in a journal, you create a feedback loop. Every trade, whether winning or losing, becomes an opportunity to refine your process, adjust your rules, and strengthen your mental resilience. Without preparation, losses feel chaotic and confusing. With preparation, each outcome contributes to a growing understanding of both the market and yourself. Over time, this disciplined approach compounds, producing consistent growth and reducing unnecessary emotional stress. Ultimately, preparation is not an optional step or a minor detail, it is the foundation of consistent trading performance. It encompasses technical planning, mental conditioning, emotional rehearsal, and systematic routines. It is the invisible work that ensures every action you take in the market is deliberate, calculated, and aligned with your goals. Those who invest in preparation protect themselves from impulsive decisions, unnecessary losses, and psychological burnout. They approach every trade with a clear plan, a resilient mindset, and the confidence that comes from knowing they have done everything possible to maximize their chances of success. Risk management is often misunderstood as nothing more than numbers on a screen, position sizes, stop, loss levels, and capital allocation. While these elements are essential, true risk management extends far beyond calculations. It begins in the mind, with a commitment to follow your plan without hesitation. Every trade carries inherent uncertainty, and the only way to survive and thrive over time is to manage both external risk and internal discipline. A trader who understands this knows that preparation and execution are only as strong as their ability to adhere to rules under pressure. Without mental commitment, even perfectly calculated trades are doomed. Discipline is the hidden trade. The real trade starts long before the entry is made. If a trader fails to commit to risk rules, the loss is practically guaranteed. It's not the market that punishes errors, it is the bending of rules born from impatience, fear, or greed. Scaling in too aggressively, moving stop losses, or seeking revenge after a loss are all examples of discipline failure. These behaviors may feel justified in the moment, but they directly contradict the principles of proper risk management. Each deviation is a step away from consistency and a step closer to account destruction. Discipline acts as a protective barrier, ensuring that even when trades go against you, losses remain controlled and manageable. Rules are the backbone of consistent trading. Most losses occur not because of the market, but because traders allow impulses to override their plans. Instant gratification, whether through entering a trade early, increasing position size, or holding too long, is the enemy of consistency. Rule-based trading creates a framework that removes emotion from decision-making. By committing to rules before execution, a trader avoids being hijacked by short-term impulses. Every market move can test patience, but adherence to established rules ensures that each reaction is deliberate rather than reflexive. Over time, the discipline to follow rules compounds, producing a sustainable edge that no indicator or strategy alone can replicate. Checklists and pre-entry rituals reinforce this discipline. Simple mental or written steps performed before pressing buy or sell act as a final alignment between mindset, risk tolerance, and trading plan. These routines verify that each condition is met, position sizing is correct, stop loss is in place, targets are defined, and emotional readiness is confirmed. By externalizing this process, the trader creates a pause that prevents rash decisions and ensures consistency. The checklist is not just a technical tool. It is a mental safeguard that allows the mind to execute with confidence, even in volatile conditions. Consider a trader who knows their maximum risk per trade, but repeatedly moves stop losses further away in hopes of avoiding a small loss. Each adjustment may feel harmless, but cumulatively it destroys risk management. Discipline, not the market, is the gatekeeper of capital. Similarly, scaling into trades too aggressively or seeking revenge after a loss creates exposure beyond comfort zones, amplifying the psychological and financial consequences of errors. Rule-based execution protects against these impulses, keeping losses within defined boundaries and preventing emotional spirals that can compound quickly. True risk management also requires accepting losses when they occur. A disciplined trader understands that no strategy guarantees success on every trade. The market will fluctuate unpredictably, and positions will occasionally go against expectations. The difference between a successful trader and a struggling one is the ability to accept these outcomes without deviating from the plan. Emotional reactions such as frustration, panic, or overconfidence are mitigated when rules are followed consistently. The mindset of accepting loss as part of the process is integral to long-term survivability in trading. Mental commitment to risk rules creates freedom. Paradoxically, strict adherence allows the trader to act confidently within defined limits. When position sizes, stops, and targets are respected, the mind is free from second-guessing. Each action is deliberate, measured, and aligned with both strategy and risk tolerance. This alignment reduces stress, increases focus, and creates the conditions necessary for rational execution. A trader who respects their rules is not trapped by fear or greed. They operate within a controlled environment that allows consistent performance over time. The consequences of neglecting discipline are clear. The market itself cannot destroy a disciplined trader. It is the lack of adherence, bending of rules, and impulsive behavior that causes failure before the trade even begins. Every deviation magnifies risk and erodes confidence. Losses accumulate not because setups are imperfect, but because the trader abandons the very principles that were designed to protect them. Consistency is built in the invisible space between preparation and execution, and discipline is the bridge that connects them. Engaging with this concept requires honest self-reflection. Many traders attribute losses to external factors, market volatility, unexpected news, or technical anomalies. In reality, a significant portion of losses originates internally from bending rules in pursuit of instant gratification. Recognizing this is the first step toward reclaiming control. By committing to rule-based trading, maintaining position sizes within predefined limits, and using stop losses without adjustment, traders reinforce the mindset that protects capital and preserves emotional stability. This self-awareness transforms risk management from a theoretical exercise into an actionable, practical habit that directly impacts results. Ultimately, risk management is both a technical and psychological discipline. Position sizing, stop losses, and capital allocation are the tangible elements, but mental commitment, emotional control, and adherence to rules are equally vital. Discipline ensures that trades are executed according to plan, that losses remain contained, and that emotions do not dictate decisions. The market may be unpredictable, but a disciplined approach guarantees that the trader remains in control, able to navigate uncertainty with confidence and consistency. This mindset creates resilience, protects capital, and forms the foundation for long-term success in trading. Execution is often mistaken for the core of trading, but in reality, it is just the tip of the iceberg. The majority of a trade's outcome, 80% or more, is determined long before you click buy or sell. Every pre-trade routine, mental rehearsal, and risk assessment contributes to this invisible foundation. When preparation, mindset, and discipline are aligned, execution becomes almost automatic. It is the visible expression of invisible work, a reflection of the mental and strategic groundwork laid beforehand. Traders who ignore this connection often find themselves reacting to the market instead of acting from a place of control. Every hesitation, deviation, or impulsive decision during execution can be traced back to inadequate preparation or a lack of emotional mastery. Post-trade reflection is where learning begins. Journaling is an essential tool for connecting execution to improvement. recording not only the technical details of the trade, entry exit, position size, but also the mental state, emotional responses, and adherence to the plan creates a complete picture of performance. Notes about what triggered fear or greed, how well preparation routines were followed, and whether rules were obeyed provide insight into the invisible factors affecting results. This practice transforms every trade, win or loss, into actionable feedback. The trade begins before entry, but the learning begins after exit. Without reflection, mistakes are repeated, habits remain unchallenged, and progress stagnates. Reviewing mistakes is an active exercise in understanding both strategy and psychology. A trader might notice that a loss was not due to poor setup, but because of a split-second emotional impulse. Another trade might have been executed flawlessly, yet the target was misaligned with the risk plan. By identifying these patterns, a trader can adjust routines, refine rules, and reinforce discipline. Over time, this process compounds, turning small incremental improvements into significant gains. Consistency is not achieved through occasional brilliance, but through repeated, deliberate reflection and adjustment. Continuous improvement requires structure. Daily, weekly, and monthly review routines create a rhythm of accountability. Daily reflection allows for immediate corrections, reinforcing good habits while addressing lapses. Weekly reviews identify recurring patterns and emerging weaknesses. Monthly reviews provide a broader perspective, highlighting trends in performance, risk management, and emotional control. This structured approach ensures that learning is systematic rather than random. It is the compounding effect of mental and strategic discipline over time that produces consistent results. Small insights from each trade, when accumulated, elevate overall performance and resilience. Consider the journey of a trader who struggled with impulsive decisions and inconsistent results. Early in their career, trades were often reactive, driven by short-term emotions rather than a well-defined plan. Losses accumulated, not because of market conditions, but because execution lacked alignment with preparation and discipline. By committing to pre-trade rituals, mental rehearsals, and strict adherence to risk rules, the trader gradually transformed. Each trade was approached with a clear checklist, emotional readiness, and defined limits. Post-trade journaling revealed emotional triggers and rule deviations, which were addressed in the following sessions. Over months, impulsive losses diminished, patience increased, and consistent gains emerged. This transformation illustrates that mastery is a process, not a sudden event, and that invisible work before and after execution is what sustains success. Execution, reflection, and improvement form a continuous loop. Preparation sets the stage, emotional mastery ensures disciplined behavior, execution enacts the plan, and reflection converts experience into growth. This loop is what separates transient traders from those who endure and thrive. It reinforces that trading success is rarely about luck or intuition. It is about intentionally shaping the conditions under which decisions are made. The market is unpredictable, but a disciplined process ensures that outcomes are determined by skill, preparation, and self-mastery rather than chance. The final lesson is empowerment. Every trade is an opportunity to practice mastery. By implementing pre-trade routines, mindset checks, and disciplined execution, traders gain control over what can be controlled, their behavior, decisions, and responses. Post-trade reflection ensures that every experience contributes to continuous improvement. The compounding effect of these practices builds resilience, consistency, and confidence. Market success is not an accident, it is the result of mastering the moments before the trade begins. If your next trade could be won or lost before you even enter, what will you do differently?